Good morning, good evening, everyone, and welcome to our Startup Genome Global Webinar Series. Today's topic will be focusing on value creation, not valuation, how to attract venture capital and build a thriving innovation economy through commercialization. Today, we'll be starting off with a brief introduction and then getting straight into the topic. Following that, we'll be hearing what is the impact and the importance of this topic. And then we'll be ending with an open question and answers discussion. So the purpose of our ecosystem development webinar series, what is it? It's to highlight specific tangible topics for startup ecosystem acceleration in order to produce sustainable ecosystem growth globally. We at Startup Genome and our partners, we go through and explain how we support the acceleration of startup ecosystems. And as always, we want to hear your feedback. We want to hear more about what you guys would like to hear from us and from our partners. And you can reach me at adam@startupgenome.com. Previous topics include using a cloud-based data platform to track and support your startup ecosystem, multiplying ecosystem growth and policy impact, and many, many more. Our future topics include our Entrepreneurship for Climate project launch, which is going to be very exciting in about a month and a half. And as always, everyone will receive all the slides post the webinar as well as the recording. So you'll be able to have all the hyperlinks directly to you after this webinar. So it's my great pleasure to have with us this morning in our London time, 8 a.m. London time session, Stephan Kuester, our head of ecosystem strategy here at Startup Genome, based in London. Max Menke, founding partner of GrowthX, based in San Francisco. Martin Giese, managing director of XPRENEURS in incubator in Munich, as well as Andrew Goldner, founding partner in GrowthX in Nashville. So without further ado, I'd love to hand it over to Stephan.
Thank you, Adam, and Max and Andrew, you deserve the gold star. Thank you so much for joining us at 2 o'clock San Francisco time. So we really appreciate it, and I'm sure the audience does as well. As well to you, Martin. Thanks so much for being with us, although in a slightly more palatable time zone, I suppose. We are not that far away from each other. So great to have you on a topic that's been going around certainly my head, certainly being discussed with many of the SSOPs. That's Startup Genome language, means startup support organizations and programs, the incubators, the accelerators, the angel groups, and all those who make an ecosystem thrive. Really as a big topic, how do I really create long-term valuations that really, or a value that stacks up in a long-term valuation that really attracts larger rounds, follow-on rounds on a sustained basis, a topic that at least from our perspective, and I'd love to hear your opinions here, is getting more and more pertinent as we move into deep tech. We need more patient capital. Our investment cycles are so much longer. The tickets are larger. We are more dependent on follow-on rounds as we were in the days of not so easy, but shorter time cycles when we were more looking on software development, SaaS development, etc. So that's what's driving us here with this seminar, to see how do we really create the value as startup entrepreneurs or as ecosystem leaders for the startups we are supporting, as opposed to trying to have a little bit of, I think, Max, you coined the term, or Andrew, in innovation, what did you call that? An innovation party?
Innovation
not
theater.
Necessarily. Innovation theater. I love the term. Thank you so much for reminding me. But maybe not creating the value that's really required for investors and stakeholders to really follow through 5, 6, 7 years, whatever it takes. As having said, particularly pertinent in the age of tech. Yeah, that's where we want to get in, but why is this topic so relevant to us, Startup Genome? Why are we hearing it so much? Brief intro from our side. What do we have with the startup economy? GSER from last year, and we'll be refreshing the data in a few months' time with the Global Startup Ecosystem Report 2021. But what we showed last year, 2.8 trillion is the value of this economy. That's the good thing, a massive economy. Not the good thing. Its value creation is heavily concentrated in Silicon Valley, New York, London, Beijing, Boston. You see the typical suspects here. And then it really peters out. On a positive note, this has started to change, and the pandemic probably has helped spread energy and drive. So we are seeing many more tier 2 cities, as we call them, emerging, that are developing startup ecosystems. particularly, not exclusively, particularly in different deep tech sectors, really drawing upon these competencies in academia, in R&D, and trying to build as successful an ecosystem as possible. Helping this friend with our topic, creating value with the startup before we look at crazy valuations. That's why we believe it is important. So the spread is going on. We love it at Startup Genome. Our mission, our purpose is to help as many places in the world to build a functioning, a successful and fast-growing startup ecosystem. So that's why the topic is relevant to us. Just for all of you here on the webinar as information, that's the most recent network. So these are all the members of Startup Genome, our friends in this ecosystem network, where we draw upon data to see what's happening in the world, but we also share and make these connections so you all can share the insights that are being developed. So if there are any questions coming up, if you want to have a discussion with your fellow peers, here are all the contacts. They're also available in greater detail where you can pursue and continue the discussion. That should be enough from our side. I'd love to hand over to Max and Andrew for GrowthX.
Well, thank you so much, Stephan, and good morning, everybody. I'm Max Menke, founding partner at GrowthX. We're a Silicon Valley-based seed stage venture capital fund with a very differentiated approach that's quite relevant to this topic. You know, at GrowthX, we just simply believe that traction speaks louder than words. We also think that the best form of capital for any entrepreneur to raise is revenue, and they should raise it from these strange people called customers. So for GrowthX, we take an incredibly hands-on approach with entrepreneurs in every sector, in every geography, in every ecosystem to help them simply find product market fit and acquire revenue. And in doing so, we create and trade a reliable source of investment signal for angels, VCs, institutions, as well as economic development offices. And we use that signal for us to invest as well.
Everybody, I just want to say a quick hello as well. I mean, obviously, we want to spend as much time we can today on the substance of the slides. But as Max said, we do think that traction speaks louder than words. And I think something that Stephan said is also really important for us today, which is the decoupling of capital and geography. I think you see a lot of interesting things happen that was definitely accelerated by COVID, but even prior to COVID, frankly, just because there's so much capital to deploy in the system now, you're seeing it not only drive valuations, but seeing opportunities outside of the standard geographies. So really looking forward to getting into that conversation today. But again, as Max said, it's pretty simple at GrowthX. You know, we help founders find product market fit. And in return, we find that reliable source of investment signal. And for us, finding product market fit precedes venture capital. And I think for everybody out there looking to build, thriving ecosystems that are creating economic prosperity and driving wealth and driving jobs in your economies, that's the right order, because that is one of the changes that we're seeing with venture capital now as we live in this age of applied technology.
And again, thanks, Andrew. Thank you so much for being with us. I think, from my perspective at least, this is a unique combination. Somebody who enables startups to grow and to have intrinsic value, and then also acting as a venture capitalist. I think, from my perspective, I've never seen a combination before, so we are so delighted to have you with this unique modus operandi. Martin, big name in the German startup scene, big name in deep tech, big name certainly in Munich and Bavaria. Great to have you here. We would love to hear a little bit more and very briefly about XPRENEURS, which is obviously the very well-renowned deep tech accelerator in Munich, but I should leave it rather to you. So welcome to the call, Martin.
Okay, so happy to be here to represent our incubator and the Munich ecosystem. So we live and exist to help those startups, which luckily we have in abundance in great quality. We do this as a not-for-profit and with the luxury to actually being connected to Unternehmertum. So that's our mothership. It's, if we go to the next slide, it's what you called a startup support organization. So it was very much perceived for exactly that purpose about 18 years ago, when the thinking in Munich was we have many of the ingredients, but they don't yet connect in the way that they create value and give a good support infrastructure for startups. And what has developed is an organization with more than 200 people that really covers the entire range. So we do a lot of seeding entrepreneurship by having a lot of activities that reach deep into our excellent Munich universities. So we have a lot of extra lectures, presenting founders as role models, boot camps, hackathons, programs that support people to test whether the idea is worthwhile following it full time or not. We then have various programs, including mine, that actually work with the teams that dare to do the jump and really get operational with their idea. We have funding support, both very generous convertible debt for very deep tech businesses that may have a year or two without revenue and without this market validation. We also have our own VC fund. Just our little cluster for the last 2 years running has generated deal flow that resulted in more than 1 billion VC funding. And it has a second dimension, and a lot about startup success is about getting this connection to the rest of the economy working. So we have a large corporate network. So people like to use us as a catalyst to connect to the startup scene, to learn about this design thinking, agile stuff, to help with innovation products, to set up their corporate venturing arm and to connect them. And that's, I think, as Max and Andrew said it, that's the real proof. I think if no customer buys the product, any VC money would be wasted anyway. But on the other way around, if you have clear customer support, clear traction, there is no big mystery to finding VC money then. That's the one necessary ingredient for your journey. Next.
Great, Martin. Very good. You got some data.
Just to conclude, some statistics. We are a relatively young program. We are now 4 years old, and we had almost 150 startups in our program. This is really earliest stage programs. So about half of them haven't even legally incorporated at the time when we work with them. We still see an 88% survival rate. We see at least 1,200 jobs created. We see more than 80 million annual revenue created. And what I consider the most impressive on the lower left, we have about 70% who've got clear business angel or VC funding rounds with more than 300 million raised. Actually, I had a brilliant trend last week with 5 deals, more than 30 million in just 1 week. And if you know, the German ecosystem only is like 6 billion a year. So with 30 desks in Munich to play in the hundreds of millions per year is a fair share of our market.
It's an extraordinary feat, Martin. Thank you so much for being here and telling us about the story. I also like the notion of coupling the startup ecosystem as you do with your corporate client base. I think Max put it very pronounced, the strange beast of revenue. So getting a first revenue customer is the best proof we possibly can have. So that's a great example. We should dive into that a little bit more in the Q&A if you have the time. I'd like to hand back to Max and Andrew a little bit with a brief introduction. How do we actually do that? How do we attract venture capital? How do we build thriving ecosystem through commercialization, and your thoughts on how we best achieve that. Before we do that, I wanted to just show you one slide more on the issue of deep tech and funding. So from our perspective, fairly old data here, but still hugely relevant. What we saw when we did economic analysis was the emergence of tier 2 cities, and particularly those tier 2 cities in the world that have a strong R&D capability, a strong patent creation environment, a strong academic environment. That's the one hand, we call them ambidextrous ecosystems. But on the other hand side, also a thriving ecosystem, startup ecosystem, where all these patents and ideas can be put to commercial use, and it really comes together very nicely. And we've seen here the Silicon Valleys, of course, but also the Torontos or Vancouvers who really have outperformed over the last few years. So that is a great trend. Startup ecosystem, an important pillar to get innovation on the street, so to speak, to commercial use. And that's maybe a bit of a less positive news. When we look at many ecosystems, late globalization phase in our life cycle maturity model, we all start with a startup output that's 100%. And then the big question for everybody who's curating an ecosystem is, how do you actually go through the stages? This is an Australian example here, one of the big cities in Australia, where we show the deviation from what we would expect them to see in funding rounds in companies that get invested into seed, into Series A, that reach 100 million valuation or even become a unicorn. On the right-hand side, you see something called performance gap, and you can see how it increases. So there's obviously a gap in later stage, starts at Series A and then continues all the way through the funnel to later stage rounds. But we have to ask ourselves, do we really create this value? Are we good enough for the valuations? Is it a quality problem, or is it a problem of venture capital supply? Undecided, this slide doesn't give us an answer, but it raises the question. That's why we are showing it. Yeah, and on that happy note, back to Max and Andrew.
Yeah, absolutely. And so I think if we want to diagnose the problem, right, if we want to understand why exactly, VCs are still sitting on the sideline, and back to, Stephan's question, where exactly is it coming from? Is it the quality? Is it the support? Is it the VCs themselves? What we do, and again, this goes back to our beliefs at GrowthX, is that really traction solves all problems. I mean, look at the studies that Startup Genome does, CB Insights, Wilbur Labs. The vast majority of startups fail because of issues related to markets and people, not product. Yet, the vast majority of capital for startup support organizations is spent on new buildings and ping pong tables and fresh coffee. It's about training entrepreneurs to build pitch decks and build products when they should be talking to customers and building markets. And so if we want to bring venture capital in, if we want to start solving for value creation, the keystone, the key to all of this is about helping entrepreneurs at the earliest stage not be fundraising minded, but be revenue minded, be focused on protecting their runway, understanding that learning precedes revenue, and the fastest path to learning is picking up the phone or walking out the door and talking to their customers and finding that product market fit as soon as possible. And this was actually our hypothesis when we first launched GrowthX as a fund. And Andrew can certainly jump a little bit more into that as well. But, and Martin's going to talk about this, in his experience. You can go from deep tech to fintech to health tech. You can be in Europe, Latin America, Asia. And our fund is invested in everything from B2B to B2C. We even have a semi-autonomous robotic fish that has a camera on its head and swims around, lakes and ponds. At the end of the day, products and markets are unique, absolutely. But when it comes to commercialization and actually creating tangible economic impact, make no mistake, the path to product market fit is not unique, it's formulaic. And what's missing to create commercialization and economic impact, jobs, and true valuation is providing startups with a framework that enables them to actually capture revenue. And that's what actually speaks, and Andrew can jump onto this here, that's what actually speaks to venture capitalists.
Yeah, and I think about it, the one piece of actionable advice I can give everybody that's listening today, and Stephan, it has directly related to the point you were just making about what is the challenge that ecosystems face, and is it a lack of capital? It's certainly something that you hear from startups, but when you really dig into the data, you find that it's not an absence of capital in the vast majority of these nascent startup ecosystems. It's simply an inefficient marketplace where the supply and demand aren't talking the same language, right? The supply of the startups and the demand from the venture capitalists or vice versa, right? What you're seeing is capital is sitting on the sidelines because capitalists who are not actively participating in the ecosystem haven't bought into it. Capitalists don't understand why, marching startups across the stage 10 minutes at a time with strobe lights and rock and roll music in a theater has anything to do with solving people's problems and doing so scalably and profitably. And what we have found, and Max can talk about this, in the context of case studies, what we have found in the ecosystems that we're in is where the focus is bringing the startups and the capital community together, not around the theater of startups pitching to the VCs, but a celebration of the startups and how they interact with their customers, right? How do you elevate the startups to that level and then create a conversation that enables them to talk from the bottom up to the capitalist about how they intend to go to market and seek profitability over time, instead of the typical slide number 7, which is that we have a $12 trillion total addressable market. If we just get 1%, look how much money we'll make. And, we joke, we make light of it. It may sound trivial, but I'll tell you that the number one, well, I wouldn't say the number one, but one of the top things that anybody can do in an ecosystem to get it thriving is to lead with traction, to lead with enabling the startups to raise money from their customers, as Max said, and to a point that Martin talked about, in our worldview, it ain't dog food until we see dogs eating it, right? So start there, and the capital will follow.
And on that note, just as a question, your perception here, going to revenue prematurely. So love your model, love the approach, but is there possibly a danger of pushing somebody to go for revenue prematurely once the product really needs a little bit more development work? We see that sometimes when people are
they
desperately go for the first contract.
It's a great question, and I'm going to turn it back over to Max on this one, but I'll leave you with saying that we don't push anybody to revenue. As Max will outline for you, learning precedes revenue. We're not looking for revenue for the sake of revenue. What we're trying to figure out is an economically rational business model that starts with learning, and it's just one of the foundational elements of go-to-market that is missing.
Yeah, absolutely. It's a great question. I mean, again, not all revenue is equal, and a big thing that we hear and that we talk about with startups, with ecosystems, is let's just get specific. Right? Let's stop using these words scale. Let's stop using the term product market fit like everybody understands what that actually is, right? I mean, you can Google product market fit and you're going to find 800 different definitions, but there is no one true guideline to that. So there's all these organizations saying you got to have revenue, you got to have product market fit, but everybody's sprinting towards a direction that they can't actually enter, that they can't actually put into Google Maps, right? So it's not about pushing startups to revenue too early. It's about the fact of the matter is, in most startup ecosystems, revenue is treated as a side project of the life cycle of a startup. You look at a 6-month accelerator, 2 weeks are spent on sales. 2 weeks are spent on sales, so where's the valuation coming from? And what's the message that the ecosystem or the accelerator is presenting about how the startup should prioritize revenue? Because if your accelerator program has a couple of random mentors who come in and occasionally dust a little sales speech, for a week or two, then you're communicating to the startup that all those other concepts are more important than revenue. And so we're not saying that you have to flip the whole ship around, but I think there has to be, and what certainly we're seeing at GrowthX globally, is a major realignment of priorities, both from startup support organizations, but in the right types of investments, where we think the right investment is where we can see a company and their revenue beliefs, IPO, Series A, break even, whatever that is, actually matches their behaviors. And we can document it and we can track it and we can talk to their customers, and we're not investing on the promise of what typically happens, which is hope. And hopefully these guys somehow trip over backwards, stumble into, an enterprise deal and figure it out. And the last point I'll make there, just for everybody, is that, I'd love it if every day we were seeing companies that had what they needed, but it was a little too early for revenue. But what truly happens, 9 out of 10 cases, is that companies start looking for revenue when it's too late. They have 4 months of runway, or maybe 6 months of runway, but they really haven't started to build that repeatable, scalable engine. And so their options start to shrink, and they don't have the time that they need to actually earn and learn and create repeatable, scalable revenue. And it's not about scalable revenue. It's really about, learning that you get paid for, and that protects your runway. Because there's a saying in sports that's very true for startups, which is the best ability is availability. And the more startups that we can really turn into, highly scalable small businesses where revenue is a priority organizationally, the more we're going to see. And I think this is why, Martin's startups have an incredible survival rate, is because those companies know how to protect their runway. They know how to acquire revenue. And so they're much more fundable in turn.
And, I think, listen, Stephan, back to a point you just made, the question you were asking at the end there about product. I mean, listen, the kernel that became GrowthX was noticing that we had, based in the Valley at the time, but now certainly true everywhere, which is that if you know how to build products and you start a company, they call you a founder. But if you know how to market and sell products and you start a company, they call you a non-technical founder. And it's meant as a second-class status of citizen and all of the ecosystems of the audience. Why is that? That doesn't make sense in the age of applied technology, where it's so much cheaper and easier to build product, and so many more people know how to deploy product than ever in the history, right? We looked around, we couldn't find the GitHub of sales. We couldn't find the Heroku of biz dev. We couldn't find the Ruby on Rails of market development. And I promise, in every town of every person on this webinar, you would not have to travel far to bump into a coding bootcamp. But I would challenge everyone on this call to look around for a sales bootcamp and stop into the local university. And for those of you who are dialing in from a university, I asked, do you have a computer science degree? Most likely. Do you have even a single course on sales? Not the least of which an actual professional certificate or a major in sales. And so, again, to Max's point, what gets measured gets done, and the pictures and the words have to match. When we work with founders, we most often hear that they're spending roughly 15% of their time on sales. So again, to Max's point, if you're spending about 15% of your time on sales, what do you expect the outcome to be? And so, again, I think the tangible small takeaways that we can go back home with and put to action from this webinar, one of them is, making a priority of the activities that ultimately lead to customers and sales.
I'm so glad I asked the question. Thanks, Andrew. Thanks so much for giving us a deep dive here, because I hear these answers or these interpretations so many times. It's too early. We still need a funding round to get our product ready to make it competitive. And then, to your point, then we got a 5 trillion, as you put it, market opportunity. We're going to take a share of it. And I really love you guys to debunk that myth quite a bit, as you just did very forcefully. So thank you very much for going into that. Martin, little shift over to you. You are doing the same at XPRENEURS, if I understand you correctly. You are giving very sound advice that's not in the midst of technology. It's very sound advice as to culture. How do you build a sales culture? How do you drive for revenue? Maybe give us your 3-4 thoughts that you teach your XPRENEUR fellow startup founders.
No, Max, Andrew, and I are really aligned on this topic. It really clicked when we met a few months ago, and they've already also done great teaching in my program. So, but what I want to report here is the outcome, because so I recently published a book on getting those first sales done and scaling the sales organization in your company, because I felt it is the one missing ingredient where many startups still struggle. And I had the luxury to actually interview a lot of our top European founders from Celonis, Hybris, Northvolt, so many unicorn founders about their personal journeys and about their sales journeys. And if you go to the next slide, next slide. So the amazing thing was that they, one back, so the amazing thing was they shared very similar stories about the importance that sales had in their journey, about the critical junctures, and also how personal it was to the founder to get personally involved in this journey to make it happen. And I just want to give the top 10 mistakes to illustrate kind of the material we learned. But the first point, and there was some discussion in the chat already on that, sales really is founder business. You won't find this one sales expert that you can plug in and delegate it, but sales is so important and so connected with getting your product right, with getting your organization right, that it really needs to be done initially by a person that has founder powers. And that's something really all these top founders admitted. Some learned it themselves the hard way, but they are all very much in sync around this point. Next. Second error is many founders are very pleased how many different people and organizations can use their product. But that's really a dangerous fallacy. So a lot of the entrepreneurial success is finding your market, and that's typically rather narrowly defined by organizations that are very much alike, have very similar needs, and need a very similar product. So you need to find some ways to slice this immense universe of corporates, and there are obvious dimensions like geography, size of business, industry that are almost always helpful, but the real beauty is in finding your very specific criteria. Like we had some that are very specific to the pain points, some found great shortcuts just looking for a specific job title because it just proved that they had discovered the pain and they were paying attention to it. Next.
Yeah, and really briefly, just on mistake number 2, for us at GrowthX, this is such a common and total problem. And what we're talking about, we refer to it as your ideal customer profile. The vast majority of early stage companies treat their ideal customer profile really as a TAM. You know, we meet with entrepreneurs all the time where, you know, we ask them, what is your ideal customer profile? And they say, manufacturers or moms. Moms is not an ideal customer profile. You know, that's a TAM, that's a huge market segment. And the reason why this is a mistake, and again, you know, Martin and I, you know, sort of jam on this a lot, is because think about how impactful this is to what we're talking about, to commercialization and revenue. If you don't know the pain that you're solving, if you don't know exactly who your ideal customer profile is, the job that they have, the metrics that that enterprise and the person who's the economic buyer at that enterprise is measured by, that's going to impact your pricing strategy, which will affect your customer acquisition strategy, which will impact your messaging strategy. And all too often we treat these pieces as if they're separate, but make no mistake, just the effort of giving an entrepreneur a clear ideal customer profile creates a frictionless process for them to start acquiring revenue. It's such a common space.
Thanks for the support, Max. Let me go quickly through the other mistakes just to give you. Third is the beauty of doing sales is you are forced to interact with your customer and you get the hardest currency of feedback, not nice words of endorsement and time, but really opening that checkbook, which is the biggest proof that you're on the right track. Next. Somewhat a counterintuitive finding, you need to be aggressive with pricing. So that was also a very consistent theme among the winners, that they said every time we sold, we increased our pricing. and that actually negotiations never failed about price. So going too cheap, you get less valuable feedback, you don't push the limit, and it's really founders' work because no one else will do it. You'll never have your top salespeople telling you you should increase prices. So that's really an important impulse the founder himself or herself has to set. Next.
Martin, in your experience, do you need to buy yourself into your first testimonial, your first big customer you want to trot out and show everywhere, or not so much?
This one lighthouse customer and reference can be important because you get other value out of it, but it's the exception, not the norm. And if you never get a no on price, you are definitely 30, 40, 50% too low, and you quickly recover that one no by the higher margin. Next.
Thank you.
Then there's a lot of confusion about the value of pilots. And a pilot is only valuable if it has a plausible path to a long-term cooperation with someone who is representative of your target segment. We see many companies really getting distracted by pilots, doing pilots with low probability of success, low contribution to their product roadmap. And that's really a waste of time. And it feels successful because you're engaged with people who are happy to work with you, but it's still not bringing you forward on the right track. Next.
And Martin, what's driving these people? I mean, I've had some experience in combining accelerators and large international corporations. I have my own picture of what works, what doesn't.
It's very important always to check the intention of your counterpart. We always say if it's only an innovation department of people full-time paid to interact with startups paying attention to you, it's dangerous. If you have clear access to the business unit behind, and ideally even the funding comes from a responsible manager having his own budget in mind, then you're probably on the right track.
Yeah, thank you, Martin. This was the insight I was looking for. Thank you so much.
Yeah, then sales really is a process that goes to kind of predictable steps. You need to take them in the right order. You also can't jump them. And you should really be successful even with those prior steps of filtering down your process. You also need to be ready to always adapt that process. When you change the country, when you bring in new product features, key parts will change, and you always need to consider it a living system. And key point is you shouldn't clog up the process with too many low probability people. So also a no, it feels like a setback, but actually it's process because you learn not to waste your scarce resources on this customer. So you should always push for either moving into the next stage or a no, and not have people linger around in this process for too long. Next. All this actually can be done with a lot of analytics and reporting. So it's not an area of gut feel and hero people. It's really something that can be measured, analyzed, and constantly improved. And that's something you also need to set up and use for the benefit of your business. Next. It's really a people business. It's a people-intensive business. Often in the hiring plan, this may be the largest function of your business over time. And in the book, we really spell out 4 stages. So we say the founder needs to start. We discuss which functions he should give up earliest, which is actually the early part of the funnel, generating leads and qualifying them, whereas the closing and demos remain with him way longer. And then how to build up what in the end will be a very differentiated sales function. And final mistake, number 10. Getting your first sale as your entry ticket into a customer is really only the beginning of a joint journey. And there's immense value in a function called customer success, which means both delivering on your promise and keeping your customer happy, and also upselling. It's actually a hallmark of many of these successful companies that they have negative churn, in the sense that their occasional rare loss of a customer is more than offset by the deeper penetration of the existing customers. And if you model that, that's in theory infinite growth if you grow deeper and deeper in your existing customers. So that's an important function to optimize. Last
So
slide from me.
More farming, less hunting, although the hunting comes with more kudos.
Yeah, it's another form of hunting, but it's smart hunting because you already have all the inroads, all the connections, and you have supporters within the organization. So you get more revenue growth for the same resources.
Important point. Yes, indeed.
And last but not least, as this book is just published, I'm really trying to get the word out into all corners of this globe. And I think this is probably my best opportunity to reach so many corners. I was very impressed. Even Fiji is apparently in this session. So I'm very happy to even share a draft of the book for you temporarily. So if you can link up with me on LinkedIn, I'll be very happy to give you free access. I hope you look into it, and if you find it useful, help me spread the word about our project. Thank you.
So fellow network friends on the network here on the webinar, get out your scanners for the QR code. Martin, I certainly will have a good read over the coming weekend. So thanks so much for the very kind offer. I think we got a wealth to learn here, and I really love the top 10s because even in our business, we sometimes don't respect them. We always try and aspire to, but not always. That's so important. Good preparation, going to revenue at the right time, good market segmentation, getting pricing right. What's the impact? What's the impact of being prepared? That's what we want to discuss to the end of the seminar. I think we got great examples. Max, Andrew, you got a case study from Alberta, which from my perspective, we are working there at the moment, is an environment that's slightly more deep tech. It's an unusual ecosystem in a sense, in its sector structure and its sector opportunities. And Martin, obviously, you of course coming from the Munich deep tech environment as well. So this will be interesting to see. But I'll leave it here to Andrew and Max first. Alberta as a case, what have you achieved? How did it work?
Yeah, well, actually, I find that the Alberta ecosystem is actually quite representative of ecosystems all around the world. We worked with them specifically. I mean, it's backing up, talking about impact. What did we actually do? And one of the reasons why we also really enjoy Martin's sort of 10 mistakes here is it goes back to something I mentioned earlier. Products and markets are unique, but the path to product market fit is not. I mean, every one of those 10 steps that Martin outlined is not unique to a B2B company or a B2C company, a deep tech company, a fintech company, or health tech company. So the question for us at GrowthX is, what if we took those 10 steps, or what if we took a process that we do inside of our fund, and we just simply gave founders a tangible playbook to start talking to their market? We're not talking about turning entrepreneurs or data scientists into salespeople, but just simply enabling them to have reasonable conversations with their market and to see what happens. And we were very fortunate to partner with some folks. This is one of many organizations we've partnered with in Canada. We've partnered with organizations all across the United States. Actually, just while we've been on this call, we've launched over 50 startups in Korea, and all of it has been through our primary tool, which is MXP Online, or which stands for the Market Acceleration Program. So that's our go-to-market playbook that we've used for both of our funds internally. And so actually, next slide, Stephan, I'll share a little bit more about it. So for their organization, like many, they were federally funded, accelerator programs have been going on a long time. They've been doing the typical, government-backed accelerator where there's lots of focus on short-term programs, multiple government-backed programs, lots of focus on pitching, on maybe a lean canvas or a business model canvas, how to do your data room, things like that. And after taking this approach to value creation, the government finally hit the stop button and said, enough. this is clearly not the type of result that we're trying to invest in. We've been approaching the startup ecosystem this way for a decade, and yet we have no more unicorns to point to. There's no more economic impact. So something has to change. So we partnered with them to deliver MXP Online through COVID entirely virtually to 26 startups, while also onboarding over 30 local coaches so that the learning and the coaching stayed local over a 4-month program. And the entire focus of the program was not about theoretical exercises. It was not about academia. There was no, boxes to fill in just for people doing the exercise. What we did is we took 26 companies across multiple different markets, from oil and gas to, digital influencer campaigns, from B2B to B2C, pre-revenue, post-revenue companies. And we forced those entrepreneurs to actually speak to their market. And we achieved some pretty amazing results. Next slide, please. Overall, the main point and the main results, and you're certainly welcome to read any of these quotes, but for the vast majority of pre-revenue companies, in less than 4 months, they went from not only pre-revenue to post-revenue, but month-over-month revenue growth. For many of the post-revenue companies, they saw that revenue was increasing, cost to acquire customer was going down, and they were actually seeing themselves on a path towards scalable revenue. And just in going through this program, not on working, there wasn't a single company that worked on a pitch deck. There wasn't a single script created. There wasn't a single outbound lead gen team hired to meet more folks. We took the existing tools and the existing bandwidth of these entrepreneurs, and we got them to understand what we call traction effort delta. Where can these entrepreneurs acquire the most amount of revenue for the least amount of effort, given where their company is, the stage of that company, the resource they have, being able to understand their market segment or ICP. And what comes out of all these companies acquiring revenue is a very funny thing. We're now able, as a fund, GrowthX, we have inside information that we've also traded with other funds on companies that are looking for capital. And oh, by the way, they are now investor ready. And they're not investor ready because they have a pitch deck. They're investor ready because multiple of these organizations now have more demand than they have supply. They're actually capital restrained organizations, and they need to meet investors because they actually have growth potential. I think one of the best examples, if you click the next slide, one of the best examples is 2S Water. I mean, this is a pre-revenue company that in just a few short months, again, fully virtual, almost entirely on-demand coaching, went from pre-revenue to post-revenue with more demand than she had sensors for. And Anthea had been in other, programs before, plenty of other accelerator programs before, where they taught them how to, put their documents in a data room, but they hadn't ever actually enabled her to find product market fit. And the ecosystem partner that we worked with actually said, well, we don't know, she's been kicking the tires for a while. And again, it wasn't because she had the wrong business model. It wasn't because there wasn't a market for what she did. It's because she simply lacked a playbook to find product market fit and secure it. And again, in 2.5 months, you go from pre-revenue to post-revenue, add another month and a half, you go to revenue constrained because the business is on fire. And this was a consistent outcome that we achieved. And we've been doing it across our fund. We've been doing it, in Korea and other organizations in Canada, where the outcome of this program is not a LinkedIn badge. There's no certificate of completing the MXP. The outcome is real entrepreneurs with a tangible traction narrative that not only protects their runway, but actually, going back to the main, topic of this conversation, pulls venture capital off the sideline, because now they see and have access to deal flow that isn't just, a promising young startup. Next slide. And, not only for the entrepreneurs, but you know, the ecosystem themselves had a tremendous impact. We now have over 30 coaches that are certified to run this program, and they're actually running it even without us. They're running around saying, you know, this is a tangibly different approach. We're not talking about an academic approach to go to market here. And we've created such a ripple effect in the ecosystem that, you know, many other programs are now saying, well, how can we change the name of the game? How can we get much more focused on, you know, revenue creation, on value creation, as opposed to, you know, doing what we've done for such a long time. And again, it's not different because we're better tech enabled because it's virtual. Very little of what we do at GrowthX did we, or, you know, similar with Martin, his top 10, he didn't invent these steps. They're very easily avoidable mistakes, but all too often, you know, when it comes to entrepreneurial sales, for most startups, what we're seeing is, you know, failure by Google search result. What most entrepreneurs have is, you know, whatever they can find, Googling pricing strategies or email campaigns or whatever it might be. And when you actually give them a playbook, it's incredible how quickly and successfully those companies can actually grow. And then to see the impact on the ecosystem.
And Max, on that note, you're speaking about 30 local mentors, experts you've already trained for Alberta. So my question is a little bit, if you touch 26, I think you mentioned startups really help them get from pre-revenue to revenue. How do you leverage this effect for the broader ecosystem of a few hundred? How do you really ingrain yourself? What can we?
Yeah, that's a fantastic question. Well, the first part comes to our technology-driven approach to all this. We created MXP Online to solve a capacity issue with our own funnel. So one of the issues that we see in so many startup ecosystems is that coaching is not uniform. The experience and the outcomes are not uniform. And on top of that, a lot of the coaches are spending, and by the way, that means a lot of the ecosystems, whether you're an accelerator or a government-backed economic development office, they're paying for coaching that in turn is actually lecturing, it's actually teaching. Well, so that's where MXP Online comes in. It creates a standardized, uniform language, and not just the language, but the documentation, so that the coaches are not teaching, they're executing. And when they're actually executing, then they're able to make an impact. So that's been the long tail of all of this, is that the coaches are now able to provide a consistent experience. And oh, by the way, when you enable the coaches to focus on executing as opposed to teaching, a funny thing happens. Their capacity goes up. So they're able to support many more entrepreneurs and do that at a higher quality. And I'll say a trend that Andrew and I have certainly noticed amongst some of the much more early adopters in tech ecosystems is a much more long tail approach to an accelerator, where you start providing a lot of free resources to the startup community, but at every stage where they get access to more federally funded dollars, where they get more access to more coaches, more time, more venture capitalists, it's the startup that has to prove that they're closer to traction or they're closer to investor readiness. And so when we're talking about what's the model that actually creates valuation, it's not about a 2-week or a hackathon or 6-month model. It's a year and a half journey where startups are sustainably building that traction narrative, where eventually they earn the opportunity to get that hands-on coaching to say, great, now it's time to get to market and actually start, achieving true investor readiness.
And the capital community follows and participates. I mean, it's part of what we're seeing, not in Alberta, but in different provinces in Canada, where we're highly active in Atlantic Canada. We're seeing capital coming off the sidelines that never have before. And we're also seeing active VCs. Following one of the programs that we ran there, we had 12 VC firms in the middle of a busy day come and have a conversation with us that they asked for to help understand why founders in the program that are coming through MXP are behaving differently, and how can they get an earlier look at these founders, because this is how they fill their funnel with qualified deal flow. Remember, just like when a startup is talking with a customer, when you are a startup and talking with a VC, your question, your commentary should not be about the features and the functions of your product and your company. It should be understanding who you're speaking with and figuring out how to help them. And understanding that qualified deal flow is the lifeblood of any VC fund, and fitting into that is going to bring that capital off the sideline.
That's great. I want to open it up again, Martin, Max, and Andrew, a little bit. In terms of signs that a startup really has done the homework, is ready for revenue, is developing revenue, in that sense, really becoming sustainable from a business perspective. What are the typical signs, Martin? You see so many companies, I believe 146 are in your, not cohort, but in your program, the XPRENEURS in Munich at the moment. What are the typical signs where you say, well, these guys really got it, and the other ones are probably not yet investable to that stage?
It's fairly simple. I mean, revenue kind of clearly shows as a number in the book, and especially if it's like recurring revenue, as with many SaaS business models, fairly easy to extrapolate. So if revenue is growing month over month, and then the second one is, how do they get that revenue? Is that really a one-off and a lucky coincidence, or do you really see that there's something repeatable, scalable behind the way they do it? So if they have found that formula and it shows clearly in the picture, that trumps every second thinking about the business model. So even some companies where I wasn't fully convinced of the model, when they finally showed the traction, then it's very easy to become a believer.
That's a very wise word, and I must say we are nearly on the up of the hour of our webinar, but I found it so refreshing to hear the word revenue so many times. Really talking about we are doing a business in the end. We are not working towards getting a certain valuation, the check from a VC. We are working towards building a sustainable business. Revenue is one of the precursors, one of the easy signs. Very clear. Also love so much the explanations that we got from all three of you. What are the things to look out for? What are the tools you can use? Martin, you've codified it in a book, which we certainly are going to read. And Max and Andrew, you've built a fantastic model. Not only to provide online courses, many people in the world do that, but really bring it together with local instruction, exerting your knowledge on a local ecosystem, or infusing a local ecosystem with that knowledge. And last but not least, acting as a very significant investor yourself. So again, a very unique perspective. I have to thank you so much for making the time this morning. Unfortunately, already running a little bit out of time. I would encourage everybody on this webinar to come back to GrowthX, to Max and Andrew, and to Martin. To Martin, I suppose, particularly if you are in the space of deep tech and considering setting up your business in Munich, I think you wouldn't be too unhappy to see that. But also,
we take companies from all over Europe.
There's your plug. That's great. So thanks very much for attending today. I would wish to hand it briefly back to Adam, who has one or two more words to say. And we would love to see you very soon, and watch out for the dates on our discussion around how do we activate entrepreneurship around the big pertinent question of climate change, being carbon neutral. That's coming in the next few weeks. Watch out for that. Back to you, Andrew. And again, big thanks to all of you for participating this morning.
Fantastic. Thank you, Stephan. On the next slide, we would like to conclude the webinar. So thank you, everyone, for joining from ecosystems all around the world. And a great thank you to all the panelists and the guest speakers. Thank you, Max. Thank you, Andrew. Thanks, Martin, and Stephan. And as we discussed before, we have our next webinar, Entrepreneurship for Climate, which we will be in touch about in due time. And everyone will receive the presentation slides as well as the recording. So once again, thanks everyone for watching, and thank you to all our guest speakers.
Thank you, everybody. Have a good day.
Everyone.
Take care for now. Bye-bye.